China has been a fantastic growth story. Their ability to increase growth in the economy year after year has been unprecedented. Their desire for foreign exchange and foreign debt has been ferocious. Up until now, this has allowed the wheels to keep spinning. But something has been changing, and China reacted. You came here for the truth. Today we're going to talk about China, Hong Kong, and real estate. Let's begin. China's forex reserves dropped below $3 trillion for the first time in 6 years. This is a very significant decline because they were recently at $4 trillion and now they're at $3 trillion. Percentage-wise, that is very significant. This has been not a one-off scenario, as it's talking about here in the subtitle, dropping 12 billion last month. No, this has been a trend. Month after month after month, we have seen a decrease in these forex reserves. People are not prepared for a slowdown in China. They're not prepared for any sort of change that would really affect what's happening in the markets. They're just hoping that things continue the way they are. But I've got some news for you. Things seem to be changing. Now, this article here is talking about capital outflows. Out of the South China Morning Post, they say the outflow pressure to worsen in the second half of this year as the yuan could reverse course and weaken against the greenback if the Fed reduces its balance sheet as expected, while Chinese economic growth looks likely to slow down further. Now, I want to interject right here. There's probably already 50 comments disagreeing with me, but let me interject. What we have in China has been unprecedented growth. That's a fact. They're growing faster than the countries in the West. They continue to prove that they are able to build infrastructure, that they are able to build new organizations like the AIIB. They're becoming a leader in their own way. They're partnering up with Russia. They're doing deals in Africa, in other places around the world, which the West doesn't have as much influence. So, what has been driving a lot of this growth? Well, the consumption around the world. China has been basically the manufacturing output for all the countries around the world, to a great degree anyway. However, we have seen the greatest public works projects that have ever taken place in the history of humanity in China. That is building cities before anyone has a desire to live in them. They are building infrastructure far greater than what we have ever seen before. And this here, I believe, has made a major impact on China. They have been continuing to consume commodities like crazy because they've been building infrastructure that at this time isn't needed, or at least at the time these cities were built. A lot of people will disagree. A lot of people will put their comments below, and of course, you're entitled to your opinion. I prefer facts, but your opinions are, of course, welcome. This is why I believe China has been able to do so, and many other countries would fare much better off if they engaged in these policies versus central bank quantitative easing. Now, China is doing that as well, of course, but we know that I would take any day of the week public works over printing money. I'm not agreeing with either policy. I think they're both bad. But at the very least, at least something's being built. It's not just printing up currency and giving it to bankers. That is just a ludicrous policy designed to make us poor. Now, let me, there's a lot to cover here. I don't want to take up too much of your time. So I interjected that. I wanted to mention that. Let me continue on very quickly here. The outflow pressure should be manageable unless sentiment on the yuan turns significantly more negative. Will that happen? I don't know. We'll see what happens with the dollar. At the current pace, capital outflows aren't putting much pressure on the People's Bank of China reserves, since they are largely offset by a current account surplus. That, of course, could change as well. Look at this. Chinese buyers. We're talking about Hong Kong now. Chinese buyers have been a major factor pushing up property prices in the past 12 to 18 months. Once it reverses, we estimate a 20% downside risk for prices. And he's a property analyst, this individual. Is he correct? I don't know, but it is something to take note. Another point that I wanted to make was that China has introduced capital controls. These they already had capital controls, but they are imposing new capital controls, let's say. New restrictions. Part of that is the whole deals you've seen with Hollywood and everything else. That's talking about the overseas investments in the bottom paragraph. But I'll just mention this. With capital controls, you are able to restrict the amount of money fleeing from your country. I believe that they have done this in order to stop what has been a flood, an absolute flood. Despite the fact that these numbers increase, they decrease as time goes on. However, we have seen China has been victim to capital outflows. A lot of people have been buying, of course, assets all over the world. You've seen that. You've seen the property prices increase in places like, let's say, San Francisco, Vancouver, Toronto, other places where we have a lot of foreign investment coming from China. So part of that is also the purchasing up of Hollywood corporations and businesses and land and everything else elsewhere. And China wants to just squash that a little bit. And so they are imposing capital controls. They do this. A lot of countries have done this. And to some degree, every country has their own limitations for what money can move out where. They ask you the 20 questions. You know the drill. We expect a slowdown of outbound buying activities from Chinese buyers on the back of this announcement. It's talking about the capital controls. Given the fact that mainline buyers have been the main price setters for big ticket transactions in the property market over the last few years, the expected slowdown would highly likely dampen the expectation of potential sellers and other bidders. So they think they're going to have these record-setting transactions less frequently. So of course, things are still happening. It's not like it's a ghost town out there. No pun intended. But we have to know that there are times where China will experience a setback. Then, when they experience that setback, they try to react. They put the capital controls in. They want money to stay there, and they want more infrastructure, more development in their own country. Maybe they don't want that money being sent from mainland China into Hong Kong. I don't know what the policies are going on behind the scenes. All I know is that things have been changing recently, and this is all part of the currency wars that are taking place. We want to watch out where our currency goes, because we don't want to necessarily boost another economy. We want to have our own economy being lifted up. But at the same time, you want to watch out how much currency stays in your country. It's a war, that's for sure. Definitely. There's more in here. Let me just quickly mention this. So far in 2017, mainland developers, have invested $6 billion to win 80% of all residential land tenders in the city. So mainland China has been doing a lot of these purchases in Hong Kong. They're the really recently anyway, the main buyers. That's what's happening right now. I think that could be a significant change if these capital controls really take hold and they perhaps even strengthen as time goes on. Let me just quickly cover these last two here. In Hong Kong, that's very clear. That's obvious to me, to anyone else. The rents, same thing. It's something that we need to take note of. Mainland investment demand into Hong Kong property markets has already fallen sharply since the government tightened capital controls in November 2016, accounting for just 7.2% of total investment in the city's office market in the first half of the year, compared with 31% the same period of 2016. We see a significant change here. It's showing you that the prices, though, they can continue to increase. I'm not denying that. But pay attention to the trend. That's all I'm saying. I believe this chart and below it is something very telling to me. And last but not least, right here, very quickly, M1 and M2 growth. And within the last, let's say, year, it has been declining. I think these values are generally way too inflated as it is. And as a result, we see the real fictitious economies. Okay, they're not real, whether it's China's, whether it's US, it doesn't matter. But I believe anyway, it's healthy for it to come down, but that type of thing really sets off things within this financial markets that they have, and they will react to this as well. You can see that, maybe this will become a concern for some of those analysts. They'll tell their traders to begin selling. The funds will begin selling. Who knows? All I know is that this is a fact. M1 and M2 has been declining. I just wanted to bring that to you. That's all for this video. If you found it informative, please give me a thumbs up. If you think it's wrong, give me a thumbs down. Share your opinion. Have an opinion. This is one of the only channels that tells people to give thumbs down, by the way. If you found this video informative, I know you'll find my books, The Money GPS, and my new release, Global Economic Collapse, even more informative. So these are available at Amazon. They're available at Barnes & Noble. I got them in the Kindle edition. I got the audiobook for the newest release. Those are available. Links down below. The first book, I actually talk about the US and China relationship. I also get into the 4 asset classes and how to profit from it. Whereas my new book takes on the familiar concepts, but I get into reducing your monthly expenses, becoming self-sufficient, and other topics in what I call the Money GPS strategy. So check that out. Links are in the description. Take care. As always, I wanted to invite everybody to check me out on VidMe and Steemit, so you can check those out. Of course, links are in the description. Take care. Bye.